Nearly 80% of older adults in the U.S., about 47 million people, are facing a financial crisis in retirement. Are you sure you won't be one of them? As income drops, healthcare costs rise, and assets lose their former value, more and more middle-aged families are growing anxious about their financial future. But there is still hope. In this video, you'll uncover practical, easy-to-understand investment strategies tailored to your current lifestyle, so you can take real steps toward the financial freedom you truly deserve. Before you invest, the first thing you need to understand is this: not every dollar should be invested. If it's money you'll need within the next 1 to 5 years, whether it's for home repairs, tuition, or medical expenses, keep it somewhere safe, like a high-yield savings account. Investing is only for idle money, the kind you won't need to touch anytime soon. Because financial markets don't always move the way you expect, and no one wants to panic sell during a downturn just because they suddenly need cash. Think of investing like planting a fruit tree. You don't plant a seed today and expect fruit tomorrow. It takes time, patience, and consistency. The real gains come from the power of compound interest, where your money makes more money, and that money keeps growing. Over time, this creates a massive difference. This isn't a sprint, it's a long-term journey toward financial freedom. So before you buy stocks or invest in real estate, ask yourself, am I truly ready to leave this money untouched for several years? If the answer is yes, then you're on the right path. There's one golden rule in investing that everyone, especially those entering middle age, must take to heart. Never invest money you'll need in the short term. It sounds simple, yet you'd be surprised how many people break this rule and end up paying a heavy price. Picture this: you're saving up to fix the roof, pay for your child's college, or prepare for your upcoming retirement. Would you really risk putting that money into the stock market, a place where it might jump 10% one month, then plunge 15% the next, just for the hope of fast gains? The answer should be no. And that's exactly why high-yield savings accounts are a smart choice. Not every form of investment is right for every financial goal. Money you'll need within the next 1 to 5 years should be placed somewhere safe, where you don't have to stress every time the news says the market just took a hit. One of the best places for that is a high-yield savings account. Unlike traditional savings accounts that often pay less than 0.5% interest, today's online savings accounts from trusted names like Marcus, Synchrony, or American Express can offer around 2% per year, sometimes more. 2% might not sound impressive, but remember, here you're not risking losses, and you don't have to monitor the market. It's like letting your money rest in a cool, safe place, quietly earning for you in the background. Let's say you put $20,000 into a 2% savings account for 3 years. Without lifting a finger, you could earn about $1,200 with virtually no risk. That's not magic. It's the power of compound interest, often called the eighth wonder of the world, because it lets your money grow money, which keeps compounding over time. Think of it like planting a young apple tree. You don't expect it to bear fruit in the first season, but with time and care, it starts producing every year. A savings account is similar. Not flashy, not fast, but steady and rewarding if you stick to your plan. Another big advantage? Flexibility. Unlike many investments that are locked in or require long holding periods, you can withdraw from a savings account anytime without losing your principal. That's crucial for people in midlife who are juggling multiple financial goals, from retirement planning to supporting their kids. Of course, a savings account won't make you rich overnight, but it's the safest place to keep your money when you're not ready to take on risk. Think of it as the first step on your financial journey. Once you're on solid ground, you can move on to higher yield investments, where the returns are greater, but so are the risks. And don't worry if you feel like you're late to the game. Personal finance isn't a sprint, it's a marathon. Every steady, thoughtful decision you make today brings you one step closer to a secure future.
So, if you've got money sitting idle or you're hesitating because the market feels uncertain, start with something simple, a high-yield savings account. No need to be an expert, no need to read stock charts, just patience and a clear understanding of your financial goals. Let your money work for you, safely, steadily, and stress-free.
When thinking about investing for the future, especially for retirement, many people feel overwhelmed by complex financial jargon. But there's one incredibly simple and powerful tool that's often overlooked by those in their middle years, the Roth IRA. It's like a secure investment vault that can help you retire with a much stronger financial foundation. For every seed you plant, that's your money. You place it in a special type of soil. That soil is the Roth IRA. It helps your investment grow without losing leaves to taxes. And when the time comes to harvest, after age 59 and a half, you get to enjoy all the fruits tax-free. That's the magic of a Roth IRA. Lifetime tax-free gains as long as you follow the rules. At its core, a Roth IRA is a type of individual retirement account. You contribute with money you've already paid taxes on, and then everything your investments earn, dividends, interest, stock gains, is 100% tax-free when withdrawn in retirement. That's a huge advantage over traditional accounts like a 401k, where you'll owe taxes on withdrawals later. Let's break it down with a simple example. Say you invest $6,000 each year into a Roth IRA from age 45 to 60, with an average return of 8% per year. After 15 years, you'd have about $170,000, nearly $80,000 of which is profit. In a Roth IRA, every single dollar is yours, untouched by taxes. What makes the Roth IRA especially appealing for middle-aged individuals is its flexibility. You can withdraw your contributions, the money you put in, at any time without taxes or penalties. Only the earnings need to stay in until you meet the age requirement to keep that tax-free benefit. That means you have access to your funds in an emergency, which adds peace of mind. Plus, Roth IRAs don't limit you to one type of investment. You can choose individual stocks, index funds, ETFs, or bonds, whatever suits your knowledge and risk tolerance. In other words, a Roth IRA isn't the investment itself, it's the tax-free container that holds your investments. Why does that matter? Because if you invest outside of a tax-advantaged account, you'll pay taxes each year on any earnings, dividends, capital gains, and so on. But inside a Roth IRA, none of that is touched by taxes, which lets compound interest work more powerfully over time. That's how a normal investment can grow into something much larger. There are a few rules to keep in mind. To contribute to a Roth IRA, your income must be under a certain limit, adjusted annually, and there's a cap on how much you can contribute each year. In 2025, the limit is $7,000 for those aged 50 or older, thanks to the catch-up contribution rule. If you're in your middle years and haven't started a Roth IRA yet, it's not too late. In fact, now is the perfect time to take advantage of the years you have left before retirement to shelter your savings from taxes. When combined with other accounts like a 401k, a Roth IRA can give you a more diversified tax strategy in retirement, letting you draw money from different sources without being pushed into a high tax bracket. In short, if you're looking for a tax-smart, flexible way to invest while harnessing the power of compound growth, the Roth IRA is a tool you can't afford to ignore. It's not as complicated as it seems, and it's definitely a better strategy than letting your money sit idle. Think of it as a vital part of your retirement blueprint. So when the time comes, you're not just free to rest, but financially free to truly life. When people think about investing, many picture a stressful scene, bouncing stock charts, dense financial jargon, or fast-talking analysts who sound more like they're rapping than speaking. But in reality, you don't need to be a financial genius to get started, and you definitely don't need to spend your days glued to market updates. That's exactly why index funds have become the simple, effective, and trusted solution for millions of people who want their money to work smarter, not harder. If you want to invest in the stock market but have no idea which company to pick, Amazon, Apple, or a company you've never even heard of, Here's a simpler answer. Instead of trying to choose individual stocks, why not buy a basket that holds hundreds, even thousands of companies all at once? That's exactly what an index fund does. An index fund is a type of investment fund that mirrors the performance of a major market index, like the S&P 500, which includes 500 of the largest U.S. companies, or the total stock market index, which represents nearly the entire U.S. stock market. When you invest in one of these funds, you're essentially owning a small slice of the whole market, giving you instant diversification without having to analyze each stock one by one. That's why index funds are often called lazy but smart investing. You just invest consistently, leave it alone, and let the market do the rest. No pressure, no stress, no chasing headlines. In fact, you might even forget about it, and then 10 or 20 years later, open it up and smile. And the returns? History is on your side. Over the past 90-plus years, the U.S. stock market has delivered average returns of around 7 to 10% per year after inflation. That means if you invest $100,000 in an index fund and leave it untouched for 20 years, it could grow to over $400,000, all thanks to the power of compound interest, often called the financial snowball machine. But there's more. Index funds are also incredibly low cost. Many charge just 0.03 to 0.05% in annual fees. That's just $3 to $5 per year for every $10,000 invested, while actively managed funds or brokers often charge much more without consistently outperforming the market. You can invest in index funds through well-known companies like Vanguard, Fidelity, and Wise. Depending on your goals, you can choose the fund that offers the best mix of diversification and low fees. Just make sure you understand where your money is going and hold it with patience over the long term. For those in their middle years, index fund investing can be one of the most low-stress, low-risk, yet high-impact strategies. Investing isn't about hitting it big overnight. It's about steady, deliberate growth. It's how you build a strong financial foundation for retirement when you no longer want to work 40 hours a week, but still want your money working hard to support your lifestyle. You may not become a millionaire overnight, but if you invest consistently in index funds over 10 to 20 years, you'll likely find yourself enjoying a quiet, confident kind of financial freedom. No hype, no waste, just lasting, controlled wealth. Because investing doesn't have to be complicated. Sometimes simple, consistent, and patient is the winning formula. And if there's one tool that proves that perfectly, it's the index fund. When it comes to building wealth, one of the simplest and most effective tools for achieving financial freedom might already be right at your workplace. It's called a 401k, a retirement savings plan designed to help you grow your wealth steadily over time, not overnight. The 401k has quietly served as a financial companion for millions of American workers for decades. At its core, it's an investment account where a portion of your paycheck is automatically set aside, before taxes, and invested in things like index funds, target date retirement funds, or more conservative options. The key here is the money is taken out before taxes, which means you pay less tax now and have more money working for your future. Let's say you earn $60,000 a year and contribute $6,000 to your 401k. You'll only be taxed on $54,000, not the full $60,000. It's not just a smart way to manage your income, but also a highly efficient way to save and invest. And over decades, that money can grow into a substantial retirement fund, thanks to the power of compound interest. But that's not even the most exciting part. Many employers offer what's known as an employer match. For example, if your company offers a 100% match on up to 5% of your salary and you contribute that 5%, they'll throw in an equal amount, free money. Skipping out on a 401k match is like saying no to one of the easiest, most legitimate ways to earn more without doing extra work. So the rule is simple. Always contribute at least enough to get the full employer match. Otherwise, you're leaving free money on the table and missing one of the best wealth-building opportunities available to working Americans.
Now, it's true that 401k funds are meant for retirement, so you can't withdraw them freely before reaching retirement age without penalties, usually a 10% fee plus taxes. But remember, this account is for your future self. So when the time comes and you no longer want to work, you'll have the financial comfort to actually enjoy life. That's what wealth mindset is all about, delaying gratification today for lasting freedom tomorrow. Another major plus, you can choose how your money is invested inside your 401k. The most common options are index funds or target date retirement funds. If you're unsure when you'll retire, target date funds are a smart hands-off option. They automatically adjust the risk level as you age, so you don't have to manage it yourself. If you're in your 40s or 50s and feel like you've started too late, here's the truth. Every dollar you invest now still has time to grow significantly over the next 10 to 15 years. And if you haven't been taking advantage of your employer match, that means there's still untapped potential right in front of you. It's never too late to start. What matters is that you do start. Think of a 401k like a self-watering garden. Every month, you plant a little seed. Your employer adds more. And over time, you grow a financial garden that can sustain you in retirement. Not because you did anything flashy, but because you stayed consistent. Investing doesn't have to be complicated or overwhelming. Sometimes just understanding and using the tools already available to you, like a 401k, can take you halfway to lasting wealth.
On the journey to financial freedom, there's one area of investing that has always attracted those eager to build wealth quickly: individual stocks. It's like picking the winning horse. If you choose right, the rewards can be extraordinary. But if you choose wrong, the consequences can be just as significant. Buying individual stocks simply means investing directly in a specific company, whether it's a tech giant, a well-known retail chain, or an up-and-coming energy startup. You're betting that the company will grow, its stock price will rise over time, and you'll profit from owning a piece of it. Sounds exciting, but this is also one of the most challenging areas of investing. No one on earth can predict the future with certainty. Even the most stable, successful companies today can face unexpected risks tomorrow. That's why investing in individual stocks isn't ideal for everyone, especially if you don't enjoy monitoring the market regularly or aren't prepared for major volatility. That said, if you have a small portion of your portfolio you're willing to play with, individual stocks can be a rewarding part of the mix. Historically, there have been companies that grew multiple times in value over just a few years, offering 3x, 5x, or more in returns. But just as many once celebrated companies have crashed, wiping out a large portion of investors' wealth. This is where the line is drawn between long-term wealth building and trying to get rich quick. Individual stocks aren't inherently bad. They just require knowledge, research, and above all, discipline. You need to understand how the business operates, what gives it a competitive edge, what risks it faces in the market, and how its leadership plans to grow. A smart way to approach individual stock investing is to cap it at a small percentage of your total portfolio, say 10–15%. The rest can stay in more stable vehicles like index funds or retirement accounts. This way, you gain exposure to higher returns without putting your entire financial future at risk. And don't forget, if you invest in individual stocks through accounts like a Roth IRA or 401k, you also get powerful tax advantages. Gains in these accounts grow tax-free or tax-deferred, allowing compound interest to do its work even more effectively. One important rule for middle-aged investors: never put all your eggs in one basket. No matter how much you believe in a company, always maintain diversification. A sharp drop in a single stock should never be able to derail your entire financial plan. The right investment mindset isn't just about picking winners, it's about managing risk and setting realistic expectations. Investing isn't gambling, it's strategy. Individual stocks can be a great tool if they're part of a broader, well-balanced approach, not your only path to wealth.
In the end, investing in individual stocks isn't a question of should I or shouldn't I. It's a question of how much and how wisely. Done right, it can be an exciting and profitable addition to your portfolio, helping you stay engaged, stay in control, and truly feel like you own a piece of the business world.
In the world of investing, if there's one area often seen as a foundational pillar for lasting financial success, it's real estate. No matter how markets rise or fall, no matter how investment trends shift over time, owning tangible assets, a home, a rental property, or even a small building, continues to hold its ground as a powerful long-term wealth-building tool. The reason is simple. Real estate doesn't just appreciate over time, it also generates steady cash flow, comes with tax benefits, and allows you to leverage borrowed money to grow your wealth. It's a rare 3-in-1 formula that few other investments can match. For those in their middle years, real estate may not be about trial and error anymore. It's about making smart, deliberate moves. This is the phase where you want your capital to start working for you, producing reliable passive income. And real estate is one of the best vehicles to do just that. Let's start with cash flow. When you own a rental property, say a 2-bedroom home in a densely populated area, you receive monthly rent payments. After covering expenses like taxes, maintenance, and your mortgage if you have one, what's left is real income. And the best part? You earn it whether you go to work or not. Unlike stocks, you don't need to sell the asset to realize gains. It pays you while you hold it. Then there are the tax advantages. In the U.S., landlords can deduct mortgage interest, repairs, depreciation, and more, effectively lowering the taxable income from their real estate investments. This means you can be making money while significantly reducing your tax burden, a major win for any smart investor optimizing their financial strategy. Another key advantage is leverage. Instead of paying $300,000 in full for a property, you might only need to put down 15 to 20%, around $45,000 to $60,000, with the rest financed by a mortgage. While you're paying off the loan over time, your tenant is effectively helping cover that payment. Year after year, your equity grows, even if you're not contributing more from your own pocket. It's no surprise that around 90% of millionaires have some connection to real estate. That's because it's not just an asset, it's a financial engine. It protects your wealth from inflation, builds value over time, and can create a reliable income stream. With the right strategy, real estate can serve as a rock-solid pillar on your path to financial freedom. Of course, no investment is risk-free. Real estate comes with responsibilities, managing tenants, handling repairs, navigating market downturns. But with preparation, good management, and a long-term proactive mindset, real estate remains one of the most secure and effective ways to build sustainable wealth. And today, with technology and transparent online platforms, it's easier than ever to learn and participate in the real estate market. You can start small, buying a modest property, or even invest passively through real estate investment trusts, REITs, if you're not ready for hands-on management.
Whatever path you choose, the message is clear. Real estate deserves a place in your long-term investment portfolio. It's not just a safe haven for your wealth, it's a tool that can help you create true financial stability. A steady step forward on the journey from working for money to letting your money work for you, so you can retire with confidence, not concern. When it comes to investing, most people think of stocks, real estate, or retirement accounts. But there's another form of investment that's just as powerful, one that can often deliver returns far beyond traditional channels: investing in yourself and your own business. In many cases, this is the breakthrough that transforms steady wealth building into true financial freedom. Investing in yourself can start small: a course to sharpen your skills, a side project selling something online, or building a personal brand in a field where you already have experience. If you're in your middle years, you have a key advantage many younger people don't: life experience, deep industry knowledge, and a network of relationships. When leveraged correctly, these can be turned into highly effective business opportunities. Let's say you've spent over 20 years in a specific industry. You likely know the common problems people face. If you can create a product, service, or solution to solve one of those problems, you're not just sharing knowledge, you're turning your experience into value and value into income. For example, if you invest a few $100s into ads for a digital product or consulting service and do it right, you could generate several times that amount in revenue within weeks. That's a level of ROI few traditional investments can achieve in such a short time. Of course, entrepreneurship comes with higher risks. There's no guarantee of success on your first try. But unlike stocks or real estate, where outside forces often dictate your outcome, in business, you're in control. You decide the product, the messaging, the customer approach, and how to adapt to feedback. That control means if you're willing to learn, iterate, and adjust, you can build a system that generates stable, even passive income over time. One critical ingredient in business and self-investment is mindset, the ability to think big, stay focused, and play the long game. Success in business rarely comes from luck. It's the result of constant testing, calculated risk-taking, and learning from every move. This is where compound interest of the mind kicks in. You're not just multiplying money, you're multiplying personal value and your ability to solve meaningful problems. And there's a bonus that comes with building something of your own: freedom. You're no longer fully dependent on a paycheck or your boss's decisions. You choose how to spend your time, who to work with, and how to align your lifestyle with your personal values. For many in their 40s and 50s, this isn't just a financial decision, it's a lifestyle choice. Keep in mind, you don't need to launch a startup or build a massive company. Investing in yourself can be as simple as learning tech skills, studying digital marketing, or selling handmade goods through an e-commerce platform. Every small step in a direction you care about is another brick in the foundation of future financial independence. In short, investing in yourself and your own business is one of the most active, empowering forms of wealth building. It's not for everyone, but for those willing to learn, act, and adapt, it may be the fastest path from stability to freedom. And along the way, you may discover that success isn't just about how much you earn. It's about how much control you have over the life you're living. Thank you for staying with us until the end of the video. That alone is a meaningful first step on your journey to building wealth and working toward financial freedom. I hope today's insights have helped you better understand simple, practical investment options that align with the mindset of today's modern middle-aged investors. Feel free to leave a comment below. What strategy are you currently using to improve your personal finances? Don't hesitate to share. A strong community grows when we learn from one another. See you in the next valuable episode.